Good afternoon, everybody. The Committee on Financial Markets and Investor Protection is yet again back with an insightful program. This time we have two learned gentlemen who are also chartered accountants, CA Ankit Maheshwari ji and CA Kuldeep Kothari ji. Before I give them an introduction, the introduction of the topic due for this fine afternoon is Cultivating Investor Trust, Illuminating Insights in Annual Reports, Transparency. Now, as your moderator, before the proceedings for this afternoon, it falls upon me to introduce your learned speakers for this evening. CA Ankit Maheshwari ji is a highly accomplished and a dynamic chartered accountant with an exceptional track record of rich professional experience of 15 years. He is also founder of a very renowned advisory firm which gives management consultancies to various firms. Coming to our second learned speaker for the afternoon, CA Kuldeep Kothari ji. Kuldeep Kothari ji is a practicing chartered accountant with a rich experience of over 1.3 decades. Sir is also working closely with SEBI LODR in the area of SEBI LODR, compliance reviews, IND AS, ESG reporting, and financial reporting framework. Without any further ado, I would request both our learned speakers to take the baton and get with the learning. Thank you so much, sir, for agreeing to take this webinar. Over to you now.
Thank you.
Ankit, sir, you're on mute.
Thank you so much,
Thank you.
Samandeep ji, for such a warm introduction
Hmm.
and such a vibrant introduction, I would say. Before we officially begin with the session, I think let me first place my thanks to the chairman of the committee, CA Durgesh Kumar Kabra ji, and the vice chairman, CA Kemisha Soni ji, who comes from my region itself. I belong to Jaipur, and she comes from CIRC. So also, my full appreciation to my co-speaker, CA Kuldeep Kothari ji, who have been, I had a wonderful experience deliberating with him together since last many years, and this is something which we are, constantly talking on various forums of the institute.
I think
And how to, in every will be very much. Sorry.
please carry on.
Yes, will be very minutely dissected. First, hear the opening remarks from my fellow speaker, CA Kuldeep Kothari, and then we start sharing the presentation and the flow of the session.
Thank you, Ankit ji and Samandeep, for such a vibrant. I would say I would echo the words of my co-speaker Ankit ji, that such a vibrant introduction. So I think the session will be vibrant and as well as lively as we all want it to be. So as Ankit ji has said, I will also place my thanks towards the chairman of the committee, Kabra ji, and Vice Chairman Kemisha Soni ji, for giving us this opportunity to interact with all of you and share our thoughts on this very vital topic. As Ankit ji has rightly said, that we have been discussing these topics or these issues across various forums of institute as well as industry also, and we always emphasize on the fact that to build investor trust, and annual reporting is something which is a very important tool per se in the way that you communicate with your investors. While we discuss this topic, I would like to place my emphasis on the fact that there are two type of reporting strategies or communication strategies that a company can follow. One is like abiding by the law. I hope and I understand that all of you, if you are from any of the listed entities, you must be doing the same. And the other is something which will take a little more effort from your side, like disclosing or making making presentation or disclosures in a way that it follows the letter and spirit of the law as well as the intention, because the intention is not mechanically to comply with what statute says. Intention is to communicate with the stakeholder in a way that he or she, the one who is reading the financial statement, who is going through the annual report, understands it in a better way. So instead of wasting much time on giving this common introduction, because as Ankit ji said, I feel that today's topic is going to be very, very, interesting. We'll be trying to put focus on what repercussions you can have as a key management personnel of a company if the disclosures are not as per the standards, if there is lack of transparency, and what is the importance of transparency per se in building the investor trust. And one very, very important amendment that has come into place and that is applicable from current year, that is shift of the focus on material accounting policy from significant accounting policy. It is not, my friends, it is not all about changing the nomenclature. It is about changing the disclosure, overhauling the disclosure. And if you are understanding that by changing the name or by keeping all the policies as it is, you will be through with this amendment. I think there is something which we all need to discuss upon, because when you read the amendment notification, which we will share at the beginning of the session only, you will see that there is a word written obscuring. So you need to figure out, analyze, and assess whether there is any obscuring information in any of your accounting policy. So over to you, Ankit, to start, and let's figure out how we can contribute and help companies adopting these changes. Thank you.
Great. I think let's straight away come to the point. And as the topic rightly suggested by the committee, the Cultivating Investors Trust and Insights in Annual Report Transparency. My few opening remarks too. There might be certain audience here who might not be well versed with the annual reports, and I'm not sure which landscape do we need to map, because Kuldeep's expertise is in mapping a landscape from as he rightly told, KMP's point of view, CFO's point of view, CEO's point of view. There might be certain audience who might be interested in knowing how do you identify whether an annual report looks shady or looks like an excellent practice. These are some wonderful insights which we'll be getting through this entire process. But I'll start with most basic thing. An annual report primarily has two sections, and we will be dissecting both of these sections, be it the financial section and be it the non-financial section. When I say the non-financial section comprises of a chairman's speech, a chairman corporate with following by a management discussion and analysis, then followed by a corporate governance report. Then comes your financials, which are the standalone financials or consolidated financials, and lastly your BRSR report, which is a statutory report for the top 150 listed companies where BRSR core framework is applicable, and for the remaining listed companies where BRSR is applicable. With changing times, right? We have integrated reporting framework coming up, which takes the forefront of the report, which also we shall try to dissect it, that how do you prepare an integrated report, and what kind of transparency is expected out of an integrated report when you say that when a company claims that they are preparing an integrated report. All in all, so we will first cover up the financial section, Kuldeep ji, because assuming that we have a lot of chartered accountants, a lot of companies from corporates joining for this session. Our first thrust will be on the financial disclosures. With financial disclosures, because itself talks about what could be the penal consequences, and we should always know how regulator is functioning. When I say regulator, so for a listed entity, the first point of regulators are the stock exchange, which are the first line regulators, be it Bombay Stock Exchange or be it National Stock Exchange.
I think we
the secondly, you want to say something?
Ankit, sir, there's a lag in your video. So if you could turn off your video, maybe due to some limited internet bandwidth due to your traveling, and then we may continue.
Does it get a bit? Does it get better?
Yes,
Yes,
sir.
yes.
Okay. So, so naturally, we are deliberating on both the aspects, the financial and non-financial aspects. And when we deliberate on both the aspects, we are first covering up the financial aspect. As I was last discussing, the first point of regulator is stock exchange in this case, and second line of regulator is is the SEBI. So that's something we have to dissect it from. Kuldeep ji will try to correlate transparency with what SEBI and stock exchanges have to say on annual report transparency. That is my that is the core idea of the session, that how regulators are behaving. Also, Kuldeep ji, in between, I will also add up how the entire ICI is also one of the regulators for the profession in itself. So how ICI is driving the force with relation to uh, building up better financial disclosures. So that should be the core agenda. The session will go in a format where we have picked up few snapshots of the annual reports. One, which we can treat it as a non-compliance, and how do you identify the non-compliance of a particular standard in an annual report or on the non-financial front. Parallelly, corresponding to this, not corresponding exactly to the snapshot, but corresponding to that particular standard, what SEBI has been acting upon, what action has been taken by the regulator. Also, in certain cases, what action has been taken by institute as a regulator when it comes to financial reporting standards. So that shall be the entire flow of the session. We want it to be, webinars generally are very challenging, and we want it to be very interactive, and that is why there is no text in the entire presentation. The entire presentation only talks about an incorrect practice vis-a-vis an correct practice, and a consequence of an incorrect practice. Hope that's clear. And then we move forward to this. So let's move on the financial section of it, Kuldeep ji. And we will, to begin with, we will first begin with the first change which you talked about. And I personally feel, Kuldeep ji, interacting with majority of the KMPs of the listed companies, not only KMPs, the corporate reporting teams of these listed companies, I realized that there is a lack of sensitivity towards material accounting policy. When you broke this conversation, I got the point that the kind of thread you are trying to catch up with. And uh, and I want to understand first from the audience, Kuldeep ji and Samandeep ji, you have to help us this way, right? What does our audience feel about the change which happened on 31st March 2023 in relation to transitioning from material accounting policy, transitioning from significant accounting policy
to material
accounting policy? What is this change? Can anybody in the audience answer this? And what kind of impact this will have on your financials, on your significant notes to accounts, as well as on your accounting policies, on your key estimates, on your judgments? So if you're aware about the change, because we are almost closing up this year, we are in mid of the March, and lot of companies are still not aware. That's my concern. And more than that, lot of auditors are not aware that how do you respond to this change. So what do you understand by this change in layman's language and in a legal language, if you can tell us? And Samandeep
Just
ji, if we
Samandeep.
have some answers to this, because generally when we pose up a query, there's a lag of, 10, 15, 20 seconds. So we might wait for 15, 20 seconds. I want to know, what is the kind of awareness we as institute has created in respect to material accounting policy, and how aware this audience is, so that I can deliberate on, or we both can deliberate on it in a easier way.
So as I'm checking up, the responses are coming. There is a not a greater extent of awareness between the difference between significant and material accounting policies. As Kuldeep sir had said in the beginning, it's not a nomenclature change, but the audience as of now, the learned audience as of now, was under the impression and belief that it seems to be a mere nomenclature change. So that's the
Okay.
response that I'm preliminary response that I able to skim through the series of response
Okay.
that
Okay.
I'm getting
So Kuldeep ji,
from all the audience and
I'll straight away, Samandeep and Kuldeep ji, I'll straight away
Hmm.
share the circular, share the notification of Ministry of Corporate Affairs on 31st March, and what change they have prescribed. Let's try to dissect it. And in meantime, if you have any specific responses coming to your side, you can always pitch in between and tell us.
will do so.
Kuldeep ji, notification is visible?
Yes, yes, it is visible. It is visible.
Okay. Okay.
I think
Let's
the
try to.
Hmm.
Please.
Before like we begin with deliberating on this particular notification, I think the main aspect which as a auditor and as a KMP or someone from the corporate reporting team of a listed company or any other company we need to keep in mind is that this material accounting policy is altogether different from the concept of materiality. So let's not mix it with the concept of materiality. Materiality is something different. Materiality may be assessed from the point of view of CBL or DR, disclosure requirements. Materiality may be assessed from the point of view of audit also. Like Ankit ji will deliberate on essay. So what is materiality? And this is altogether different. So while seeing or looking at this notification or going through your company's accounting policy while redrafting the same or taking help of anybody else also, like or auditors or any other consultant, you should keep in mind that it is not materiality, it is material accounting policy, which is altogether different. Over to you, Ankit ji.
I
Sorry for
think Kuldeep ji,
interruption in between.
no, please.
Hmm.
You rightly pointed, and
Hmm.
from auditor's point of view, so Kuldeep ji, before this change happened, from
Hmm.
auditor's point of view, I always assumed that materiality is governed by SA 320
Hmm.
and is a fact of judgment, is a matter of
Hmm.
judgment.
Hmm.
Now here they have clearly tried to quantify
Hmm.
which policy do you disclose,
Hmm.
which policy you don't disclose.
Hmm.
Second, second,
Hmm.
what part of policy needs to be disclosed and what part shall be considered as an obscuring disclosure.
Hmm.
So the quantification comes out from this. Let us, read it barely, what this change has to say. And
Hmm.
most importantly, if you talk about annual report transparency, if you talk
Hmm.
about financial reporting section of the annual report, I think
Hmm.
this is the portion where the transparency starts from.
Hmm. Agreed.
So let us start, you know, reading what law has to say and what do we interpret out of it. An entity shall disclose material accounting policy formation information. Accounting policy information is material if, when considered together with other information included in an entity's financial statement, it can reasonably be expected to influence decision of the primary user of general purpose financial statements make on the basis of those financial statements. So the first point I and Kuldeep wants to deliberate here is that the primary condition comes from paragraph 117 and which remains to be same only. Which remains to be same only, that if it is influencing the decision, again the judgmental thing which I was talking based on SA 320 is considered here. So if it is influencing a decision, that means primarily this policy needs to be disclosed. Then the question is, then what is the change? Because significant accounting policy also talked about the same. Material accounting policy is also talking about the same. The change comes with insertion of paragraph 117A, B, and 5 conditions of paragraph B. Which are these conditions, which are very essential conditions to understand. I read 117B directly. And 117B says, an accounting policy information is expected to be material if users of an entity's financial statement would need it to understand other material information in the financial statements. Now, what conditions they have laid down, the events or conditions under which only you have to disclose a policy. The first condition is if there is an accounting policy change. So you disclose an accounting policy primarily if it is significant, and secondarily if there is a change. So you have to go ahead disclosing the same. Kuldeep ji, if you permit me, after this deliberation, I'll open any of the annual report, and if you can highlight,
sure.
Any particular accounting policy as to how it is undergoing a change, I think will interest the audience who is attending this.
Sure.
Thus, the B point, please.
I would like to pose a question before you for the audience as well as my knowledge, that when we read 117, we are reading the Bare Act per se, and it says that if any information is considered like material or significant, read with the notes to accounts. So is the intention of statute is as such that it is talking about amount only, or the kind of impact that information can have on the users of financial statement? Because my understanding is something different. And I would like to hear from you that what is your view on this, that whether it is all about amount or it is about the qualitative impact and transaction can have on the users of financial statement.
So naturally, when conventionally also when we talk about judgment, materiality is never only about amounts. Materiality is not also about the current year amounts which are reflected in your annual reports. Materiality could be something which would have a significant influence in future also. So there has to be a qualitative disclosure, qualitative judgment, which you have to do. Just don't look at the numbers, that a particular number. Probably if you don't do a business combination this year, it does not exempt you to write a business combination policy at all. But the company is in the practice of doing business combinations. Hence, the policy still remains to be relevant, irrespective there is no number for the current year with respect to business combinations. That's my primary view.
Correct.
So
we are on the same page.
Hope
Yes.
it solves the answer to many people here also. What you posed is a very appropriate question. So A, primarily, yes, it has to be material. B is sub conditions, and if any one of these conditions gets fulfilled, that's where you are expected to disclose a policy. Else you will not be expected to disclose a policy. So all the companies here needs to prepare a materiality matrix. Kuldeep ji, I want to also highlight a very important point, because there are so many people coming up from corporates. All these, why I am asking for a materiality matrix? I might directly go for a change, right? But tomorrow, all these listed companies, a material accounting policy change or an accounting policy change is moved through an audit committee. Correct me if I'm wrong.
Correct. Correct, correct.
Now, an audit committee can question that why do you think it is material or it is not material? That is why a materiality testing matrix is must. And before you present your draft policies, please present it with this materiality testing matrix. Point number one. Point number two, maybe this year audit committee doesn't question. 4 years down the line, the regulator itself starts questioning that why did you eliminate the policy or why did you disclose the policy? So from there, the change which you have done for 23-24 has to remain valid for next 5, 7, 10 years. And if somebody poses a question to you, why did you not consider a business combination policy? Then it has to be documented with the relevant extracts of Ind AS. That's what the testing is all about. That why a policy is to be kept and why we have decided not to go ahead with the business combination policy. Second,
One more thing.
right, right.
I would like to interrupt you and add one more thing to this. That when we see it from the perspective of what audit committee or the regulator will come after the companies, it is as important as for auditors also, because as a auditor of a listed entity, when we are signing the financial statement, if there is any change in accounting policy, which will be there if the company is adopting or shifting to material accounting policy, we need to have an opinion on the same also. So as a auditor also, I think it is imperative for us to seek and have at least as a audit document with us this materiality matrix which is prepared by the company, so that we can, we cannot be held responsible for a change or any opinion that we are giving on the change or material accounting policy, which will be there in current year's financial statement. Ankit ji, please.
Kuldeep ji, can I add one more thing to this?
Yeah, sure.
I think an auditor should not draft a material accounting policy himself itself.
Yes.
The material
Agreed.
accounting policy has to be drafted by the management, vetted by the auditor. Right? Because once an auditor starts drafting it, right, then I told you the internal regulator, then I'll tell you what QRBs and FRRBs in the institute are also, doing. So my first point is if auditor just needs to, I agree to your point, needs to keep a backup of this documentation, take this materiality matrix from the management as to how they have tested it, certify that materiality matrix, and then go ahead disclosing these policies. But let's again go back to the law. And the second condition is if an accounting policy from one or more options are permitted by Ind AS. For example, Kuldeep ji, when I look Ind AS 109, Ind AS 109 gives us not about the initial recognition or measurement of a financial instrument, but subsequent recognition and measurement of the instrument. You have multiple two options to choose as to subsequently how do you measure or recognize a financial instrument. Thus, broadly, the initial recognition policy will be kept only to the extent of, specific particulars which are presented in the notes to accounts, not the reproduction of Ind AS. And the subsequent measurement policy has to be well defined.
Agreed.
Third, in case an accounting policy is developed in accordance with Ind AS 8, Ind AS on a particular transaction, on a particular note, there, if you want, you have in-house developed some policy, then that policy needs to come out. Fourth is interesting, Kuldeep ji, because with significant accounting policies, we have judgments also, and we have significant judgments also and significant assumptions also. My belief is whatever you are putting up into your significant judgments and assumptions, make sure that they are in alignment to your material accounting policy. There cannot be a case, and I repeat it, I reiterate it, there cannot be a case that if you have put up something in your significant assumptions or judgment and it is not a part to material accounting policy, there cannot be a case. There could be a case where you have a material accounting policy, but you have not exercised any judgments or assumptions. last, that the last talks about the complexity, and it says if the accounting is complex, and that is why 109, some part of 109 needs to be reciprocated it. But if it is a complex transaction, if you want the user of financial statement to understand, how you have dealt with the complexity and what India has expected you to deal with, and that's and you want to put your verdict, that's where you have to disclose it. Rest, no policy should be a reproduction of India's, Kuldeep. That's something which I think regulator in times to come will come very strong about it. Because the
Correct.
problem with significant accounting policies, or in the current context, material accounting policy, is that people are still, I would say, still showing uh, the material accounting policy as a reciprocation of Ind AS. And once Kuldeep ji, starts deliberating on a particular policy in an annual report, that's where I feel that you will get more clarity about it. But one more important thing, Kuldeep ji, which I feel is very important, is 117D and 117E, because these are giving me some more additional conditions for material metrics. 117D says if an entity discloses immaterial accounting policy information, such information shall not obscure material accounting policy information. And Kuldeep ji, I can challenge, that's where the regulator starts coming from.
Correct.
Wherever, and that is why I was saying mere reproduction of Ind AS, merely stating a policy from, copying it from your previous years or copying it from the peer companies, could create an obscuring disclosure, could create regulatory challenges in times to come. Last, an entity's conclusion that accounting policy information is immaterial does not affect the related disclosure requirements set out in Ind AS. So, Kuldeep ji, this is a controversial, I would say, change.
Controversial.
Where you are saying if an accounting policy is immaterial, then the related disclosure requirements, you are not exempted from the related disclosure requirements.
Yes.
I hope this is self-explanatory also, but people are taking it in, I found some bigger auditor firms taking it in a very different and very casual way. Kuldeep ji, I would also, before we go to an example, I found an IT giant.
Yes. We discussed it that day also.
Right. Who is disclosing material accounting policies. And when I spoke to their management, as to IT giant of the country, I would say it's a major company. And it is one of very few companies who are disclosing material accounting policies.
I would like to interrupt you in this. I would like you not to use the word disclosing. I would like you to use the word, I think, in my opinion, writing material accounting policy information.
Because they are not disclosing it. They are just writing material accounting policies. And when you compare their last year policy of significant accounting policy to material accounting policy, there is no change. The only change they have done is just renaming significant accounting policy to material accounting policy. Friends, please don't commit this mistake, right? This is a significant change. And the worry was, that's where the deliberation from the Committee for Financial Markets started with. That our worry was that maybe Institute has to push more awareness as to this, with regard to this change, and more guidance is yet to come. We'll try dissecting one policy for you, because the entire topic is about annual report. But maybe at some session we can only discuss material accounting policy change. Kuldeep ji, I have some you want to add something?
Yes,
to this?
I just want to I just want to sum it up for the audience, that what I have understood from what you have deliberated is that first I need to test my accounting policy. I think all accounting policies on these like 5-6 conditions. First, I need to check whether I would I would term it as a primary or essential condition, to be precise. That if it is significant that it can impact the decision of the users of financial statement, then I would come to cross check it for these 5 conditions as per para 117B. And if as you said that any one of these conditions is being ticked as yes, then the policy will become material, right, Ankit? So, but my job doesn't end here. As you said that I need to check if even if accounting policy is a material accounting policy, I need to check each and every line of that policy so that no obscuring or immaterial information is being disseminated in that policy as it is. So it is coming out of from para 117D. I am right, Ankit?
Correct. Absolutely correct. And
And
my fear is, Kuldeep ji, that
hmm,
people are testing this and removing the policy in
hmm,
entirety
hmm, hmm,
or
hmm,
keeping the policy in entirety.
hmm. Yes, yes.
So,
So, hmm, please,
please.
please. So, what you have said that vis-a-vis both situations are not ideal. That one should not remove the policy as it is, and one should not disclose the policy as it is. What that is what I have understood from what you have said.
Absolutely.
Hmm, hmm. So,
Kuldeep ji, if you can help
hmm,
us out, I have Berger Paints annual report, any
hmm,
one
hmm,
policy,
hmm,
right?
hmm, hmm.
Let's just allow me, to reshare the screen.
Sure.
Hopefully the report is visible.
Yes, yes. It's quite vibrant also. Looks vibrant.
Yes, it's a good annual report. It's a good annual
Yes, yes.
report. So
Hmm,
let's look into the
hmm,
accounting policy straight away.
hmm, hmm, hmm.
Okay.
I have a question here, Ankit ji, that whether
Right.
this basis, please, can you move on to the last page? Yes, yes, this basis of preparation. So will it fall under significant accounting policy or say material accounting policy, basis of preparation or basis of consolidation?
Very,
Do you
very
think that
interesting.
it is part
So
of
we have to
accounting
we have to
policy? Hmm,
consider three, four things.
hmm, hmm,
One,
hmm,
uh, once before we start writing material accounting policies,
hmm,
we have to give our corporate information, you know.
hmm,
And a lot of
done.
people in this
Hmm,
corporate information talks about their subsidiaries and their joint ventures also,
hmm,
right?
hmm,
That's a part of corporate information. When you say basis of consolidation, right?
hmm, hmm,
The basis of preparation and basis of consolidation, to
hmm,
my opinion, are not significant accounting policies. In
hmm,
fact, they are part of the corporate information or the information which you want to put before material accounting policy.
hmm,
Even though I'm consciously saying, and
hmm.
I know because henceforth you are also deliberating on Ind AS 28 and Ind AS 110,
Hmm,
but consciously I feel that the basis of preparation, basis of consolidation, they are uh, part of the corporate information itself and
hmm,
should not be a part of significant accounting policy. In fact, when you look down, because I've just scrolled this report down, the
hmm,
significant accounting policy starts from point 3, which is the business
hmm.
combination and
Correct. Hmm,
goodwill. So if you
hmm, hmm,
assume that it is a material accounting policy, then
hmm,
you have to do a material testing on this, because
hmm, hmm, hmm.
this talks about, then it will also talk about the current as identification of the current assets and current
Current, non-current.
liabilities,
Correct, correct. Hmm,
right? Current and
hmm,
non-current assets and liabilities.
hmm,
So,
hmm,
my point is, if you are assuming to the extent
hmm,
identification of current and non-current liability also, if you
hmm,
are assuming it is a part of accounting policy, then you have to test this for materiality testing also.
So, Ankit, would you like to when we were discussing, can you open that CB order also on classification of current and non-current, or will take it at a later stage of this
No,
session?
so I
Hmm.
first let me look where the current and non-current classification is written in this particular annual report.
Hmm.
If you allow me some time,
Yeah,
give
sure.
me a minute. Okay, here it comes, right?
Hmm.
So they have made it as a part of
Yes, yes.
significant accounting policies
Accounting
in
policy itself.
standalone,
Hmm.
but not in
Hmm.
consolidated, right?
Hmm. Hmm.
And I don't know what exempts them to do that,
Hmm.
because to my opinion, this classification shall also apply on the consolidated financial statements, right?
But again, a question whether I don't think, in my opinion, it is in material accounting policy, because what any of any it might have been done by other companies also, but it is merely reproduction of accounting Indian accounting standard only,
Absolutely,
because
absolutely. In fact, in
hmm,
fact, the SEBI order which you were talking about,
hmm,
right?
hmm, hmm,
The problem is not writing out these policies.
hmm,
So ideally, it is not a significant accounting policy. And when you claim it is a material accounting policy or a significant accounting policy, then
hmm.
you are subject to that test as a whole.
Yes, yes.
That is
Hmm,
why I would want to keep it, because this is a reciprocation, right? You
hmm,
keep it, you
hmm.
don't keep it, but don't make it a part of significant accounting policy. If you have to
Exact.
keep it above significant
Hmm.
accounting policy.
Correct, correct.
Now,
Basis of preparation also. Hmm.
importantly, the problem is the classification itself.
Hmm. Hmm. Hmm.
And to all the learned audience, Kuldeep ji, I would want to say the problem
Hmm.
is not only regarding to the classification of current, non-current. The problem
Hmm.
is regarding classification of financial assets, classification of financial liabilities, classification
Hmm.
of contract balances, classification of
Hmm.
contract assets, classification of contract liabilities,
Hmm.
and to all the orders which you send me in the morning, right?
Hmm.
These
Hmm.
orders talks about the classification issues and the kind of
Hmm.
penalties uh,
Hmm.
for such a, I would say it appears to be a very minor fault. Somebody sitting in
Hmm.
the audience might also think that, they're talking
Hmm.
too basic, but
Hmm.
they're talking about only current and non-current classification. What is there to deliberate? But to
Hmm.
deliberate this, Kuldeep ji, can you tell me the company for which I have to open this, the current, non-current order?
I think that it was Excel reality, if I'm not wrong. Excel reality it was.
Okay, let me
Hmm.
find it out.
And if you remember, while you find out that, if you remember, when we were discussing with that company, I think a month ago, they were like saying what is to be disclosed under other long-term employee benefits, if you remember. And they were
Correct,
very
correct, correct.
confused that
Again,
if
again,
hmm,
again, it
hmm.
was a matter of classification. Very true.
Yes, yes, exactly. They were confused
Again,
in between that, if for example, if there is any long-term liability and I make a provision in the current year, they were of the view that it is a short-term nature of expense, or short-term nature of provision, if I'm not wrong. So this is something,
absolutely.
the classification and presentation, my friends, is something which is going to maybe which is going to create problems, oblique, if it is done in a right way, it is going to communicate your message straight away to the head of the in the head of the investors or stakeholders. So it is kind of, it is like a double-edged sword. So if you do it in a right way, presentation, disclosure, it is going to enhance the trust in the minds of investors or the stakeholders about your company. And if it is being done in a obscuring on, or I think not appropriate way, I would not say in a wrong way, not appropriate way, then it is going to create, or it is going to fetch problems in coming times. Over to you, Ankit.
So, Kuldeep ji, I start sharing the
Yeah.
first. I'll share the order, and then we will go on the extract of the order itself. Right.
Hmm, 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 hmm.
And Kuldeep ji also deliberate on as to how SEBI is adjudicating such matters of non-presentation of annual reports, right?
Mm-hmm.
If you
So,
have, do you
nahi,
do you
so basically, I think since exchange is like I often deliberate on LODR also, that exchange is the first point of contact between a listed entity and a stakeholder or investor per se. When you list your entity or when you enter into a listing agreement with the exchange, it is kind of a tri-party agreement between you, regulator, and the exchange. It is that no submission or no dissemination of information is going to SEBI directly or the regulator directly. It will flow to exchange only, whether it is BSE, NSE, or main board portal or the SME portal itself. But the investigation or the analysis starts thereafter. It may be a case that SEBI suo motu takes these actions. In many of the cases we have seen, Ankit, you will agree to that SEBI has taken suo motu cognizance of such non-compliances. Samandeep, you will also appreciate the fact, since you were telling that you have an interest in equity markets. Ankit will remember that one company on which SEBI has slapped a fine for not disclosing the MD&A in a correct manner. Because
correct?
as an expert or as a person from financial background, I understand that as an investor, I would see the policies, then the MD&A section, and some extract of the financial statement. That's it. I'm going to have a look at almost, I think, 30 pages out of the 600-700 pages that you are publishing. So I think non-financial information, just to deviate from the topic, I'm sorry, but non-financial information is as important as financial information.
Absolutely,
Yes,
absolutely,
Ankit.
and be rest assured that we will be covering the non-financial part also. But Kuldeep ji, can you in a 30 seconds, can you brief the matter? What is the matter? Because the entire order will be like too lengthy, so I've just
No, no.
extracted.
Yes, sure. So what happened in this case that SEBI started an investigation on this company. I would not discuss the reasons why it has started, because it is something which is not of use for all of us. But what happened is that in the beginning, this company categorized the loans which were given to the wholly owned subsidiaries as non-current assets. Okay, and then these loans were reclassified as current assets in the financial 17-18. When you read para 66 of Ind AS 1, that is related to presentation of financial statement and how we classify an asset as current and non-current. So I think from auditors or companies perspective, sorry, I have taken more than 30 seconds, but I would like,
No
I
worries,
just sum it up in
no
a
worries.
minute or so. So you need to look at the time period for which, like, a particular asset or liabilities will be due into, or it will be like discharged, say, and the qualitative aspect also. And the one more important thing behind this classification saga is that once you classify any asset or liability as current or non-current, then I think every year you need to check whether it is still falling in the same bracket. So that has happened in this case. They've classified a loan to wholly owned subsidiary as non-current, then they reclassified it as current, and then they continued doing the same. But from the investigation, SEBI has found out that the loans amount or the repayment terms was not as such that they, it carried, it was carried at the same amount for a number of years. And the second was related
Kuldeep
to,
ji, I think second we cover with financial instruments,
yeah,
because
sure. Okay,
we have opened this
got your
up.
point.
This has
Yes.
become too big. Now I am
Sure.
very interested in looking at the CFO's comment into it.
Hmm.
Kuldeep ji, if you can highlight this also.
Hmm. So, whenever these sort of adjudication orders come into play, SEBI categorically, every time has come after or have commented upon the role of compliance officers and the CFOs. Because as a CFO, as a compliance officer, SEBI writes and thinks that, and it is there in the law also, that before going to the board with the financial statement of the results, it is my responsibility as a CFO, compliance officer, to make sure that it is free from any material misstatement, and it represents a true and fair view. So this is why a CFO certification or the compliance officer certification you see each and every time in the annual report, because it is part of the LODR regulation also. And I would like to place thrust on regulation 4 2 Roman 2 and subclause F, Ankit ji. It says that it is the responsibility of the management per se, KMPs and the board of directors, to make sure that the financial statement or any information which is coming out in an annual report represents a true and fair view. So basically, it talks about the responsibility of the management to preparation is the responsibility of management. It is something which auditors also write in the audit report, that it is responsibility of the management to prepare the financial statement, but as well as review and making sure that it is free from any material misstatement. It is totally compliant with the laws and regulation. It is also the responsibility. So I would suggest that if you create internally, you may have a post like financial reporting reviewer. It is something, or someone who can benchmark or oversee that whatever has been done is in letter and spirit with the law, and it is fully compliant.
So Kuldeep ji, here I have just one point to add. In majority of the cases, because maximum fellow brothers comes from our community here, who are
Yes,
chartered
yes.
accountants. Management, when you look at the representation which manage, or the or the submissions which management gives. So in case of a company, we were reading itself, right? The chairman itself says that I am not the person who is responsible. I have built up a system which is headed by my CFO, is responsible for compliance of an Ind AS. Also, sometimes it appears a classification or reclassification issue cannot, give you such kind of fines or prosecutions to that extent, because there's a very thin line between a misstatement and a material
Correct,
misstatement,
correct.
right? And a mistake or a fraud. When I
Yes,
note,
yes.
right, when I note the comment of SEBI, when I note this order, see what it has written. I note that being the CFO of Excel, notice number 5 deliberately. Now this was a deliberate. Now how do you justify this? Whether this was a deliberate call or this was a error which was inadvertently done. Deliberately choose to furnish such false certificate to facilitate the scheme of fraudulent disclosures.
Very, very serious.
So I am saying, how do you carve out a financial disclosure? Everybody sitting here should understand the sensitivity of it in itself. Because the kind of disclosures we are discussing, in fact, when we were looking at the Berger Paint reports, right, the nomenclature things, we will discuss it later also, but that's something which we have to deliberate. So interesting development. So I think we started from a place where we were talking about a material, whether a current asset or a non-current asset classification is a part of material policy or not. Both of us stand is that it is a mere reproduction of an Ind AS, and even if you are keeping it, you have an option to keep it out of your material accounting policies, but not in your material accounting policy. Two, what worries us as professionals, as experts, is that a lot of people, the regulator has started questioning such kind of disclosures which are pertaining to classification issues. This particular case was about classification of current asset and current liability, or reclassification of a non-current liability to a current liability. So I hope this solves some purpose. It was a wonderful deliberation for this particular thing, Kuldeep ji. Let's move ahead on it.
Sure.
Let's go back to the material accounting policy thing. We were discussing the report of
Berger Paints.
Berger Paints, right? Give me a minute.
So which accounting policy should we look at? Like, I would say, if you are comfortable, like we can have a look at some basic accounting policy, basic as cash and cash equivalent if it is there, and something which is complex like financial instrument, if you say.
We look, see, if I open a financial instrument, I think the evening will be short enough to even deliberate about
Hmm,
it.
hmm,
But we will pick up few
correct.
things of financial
Hmm,
instrument. We can pick up
hmm,
government grants. We can pick up revenue
ah,
recognition. Any
hmm,
policy which research and development, intangibles, right?
hmm,
Tell
hmm.
me, whatever you're comfortable. I don't find cash and cash equivalent policy here as of now.
I think it must be
Oh,
there.
we have
Yes,
a
yes, we found.
we have a cash.
Uh, hmm.
Okay, Kuldeep ji, let's open this up. 3.17. We are reading
Hmm,
cash and cash equivalent policy, one of the
hmm.
most basic policies. And then we
Basic
look at
policy.
one of the most extreme policy, which is the financial
Hmm.
instrument policy, right?
Sure, 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 sure.
And then we end up the material accounting thing,
Hmm.
right?
Sure. So when you see this cash and cash equivalent policy, it writes as cash and cash equivalent for the purpose of presentation in cash flow statement and in the balance sheet comprises at cash at banks and on hand and short-term deposits with an original maturity of 3 months or less that are readily convertible to known amount of cash and which are subject to insignificant risk of changes in value. I think you will all appreciate this fact, and Ankit ji, you will also appreciate this fact that you will find this same sort of three, four, or five liner policy around cash and cash equivalents in almost each and every company. So let's first test this on the basis of materiality per se. So whether it becomes a material accounting policy or not. So if you see whether it can influence the decision of the users of financial statement, the answer is yes. So it passes the primary test or essential test or the main condition which is there in para 117. Then we need to test it for the secondary conditions like whether it is complex, the answer is no. Whether there is any option provided by the Indies, then the tricky situation comes into play because when you test it for all five secondary conditions of material accounting policy, sorry, so you will find that it passes only one secondary condition test, which is that there is an option allowed by the Indies in respect of presentation. I think we all must be aware of the same, but this is where the tricky situation or the problem will come into play, Ankiji, that when you see Indies 7 it says, or probably AS7 it says that there is an option allowed by the accounting standard itself that you can present the statement of cash flow or the cash flow from operating activities on indirect method basis, and for others financing and investing you need to do it on direct basis. So there is an option of presentation which is being allowed by the Index 7. So in this manner it will become a material accounting policy. Agreed, Ankit or anything contrary to that?
No, no. I think the contrary will be the opinions of the
Yes, yes,
audience
yes, yes.
because
So, hmm,
because
hmm,
Kuldeep ji, I was
hmm,
reviewing.
hmm,
At least I reviewed two, three listed companies, right?
hmm, hmm, hmm,
And they have removed the policy of cash and cash equivalent,
hmm, hmm,
thinking that it is an obscuring disclosure.
hmm, hmm,
You have given us a great insight
hmm, hmm,
that it appears to be a very basic policy,
hmm,
but but there is an option which you have to exercise under the Indian accounting standard.
hmm,
So I think perfectly done.
hmm,
Uh, Next is the EPS policy. We can take EPS also along with it.
hmm,
And
hmm,
uh, EPS policy doesn't give you any option, right?
hmm,
This is
hmm,
an obscuring policy. Henceforth, Kuldeep ji, my primary opinion is I am not deliberating it in detail
hmm,
that a
hmm,
policy of EPS shall not be disclosed unless there's a change in the weighted average number of shares or the way of calculation of weighted average number of shares, or you want to, you
hmm,
know, the profit which you are considering as a part of numerator, right?
hmm, hmm,
Unless also the now what was there in 117E, right, Kuldeep ji, which
Hmm.
talked about even if this
Correct,
policy is
correct,
immaterial, the
correct, correct.
reconciliation of basic and diluted EPS will not be immaterial.
Yes,
You
yes,
still have to
correct.
show that reconciliation.
Hmm.
Next, I come to financial instrument.
Hmm.
Primarily, yes, the primary condition is satisfied. Here, two, three conditions are satisfied. One, you have multiple options. Two, the complexity of the transaction. Now, Kuldeep ji, I read the first line of the policy, right?
Sure, sure.
And we'll quickly deliberate this and then we come on the
Hmm.
other parts of it.
Hmm.
A financial instrument is any contract that gives us rise to a financial asset of an entity and a financial liability or equity instrument of another entity. This is
Hmm.
nothing but a reproduction of Ind AS.
Hmm.
You can't define a financial instrument in a policy. That's what this Ind AS amendment
Correct.
is,
Hmm.
right?
Correct.
Now,
Hmm.
with regard to initial recognition, I have already told that
Hmm.
that's the same way. There is no process, so we
Hmm.
can carve this out, right?
Hmm. Hmm.
Carve this out. This is already a carved out policy itself. Certain people
Hmm.
have very lengthy policies with
Hmm.
respect to subsequent measurement. Only the instrument which you possess
Hmm.
and the option which you have exercised in recognizing a debt instrument or an equity instrument through FVTO CI or through FVTPL, right? The subsequent policy will come. The policy of derecognition will be obscuring policy, not required, right? That's what is the reciprocation of Ind AS. You can again see that a financial asset is primarily derecognized for the following reason. Kuldeep ji, but
Hmm.
you had some issue pertaining to a financial liability derecognition.
Yes, yes, it was there. It was there in,
Okay,
yes, yes, AB. It was there in that I think Royal Orchid Hotels case, in
okay,
which I think it
okay.
was there
I'll
in
come on it.
three more places I've seen this. In that one order also of Omkar's specialty I shared you in the morning. So
Kuldeep ji,
it was.
okay. This company,
Mm,
I'll open that up, right? When I
mm,
come to the
mm,
financial liability part. In
mm,
this impairment
mm,
of financial asset, right? So
mm,
naturally, financial assets, non-financial assets, right? Certain people write specific policies to impairment.
mm,
Interestingly, Kuldeep ji, they tested on an impairment on non-financial assets, right? And
mm,
remove the
mm,
policy of impairment on financial assets. They are separate policies. Keep them
mm,
separate.
mm,
Uh, this policy has to be reproduced uh,
mm,
to the extent uh, the kind of methodology we are using for impairing our financial assets.
mm,
Also, very important thing, Kuldeep ji, since this policy is being deliberated,
mm.
I think a lot of companies, if you want to deliberate about usage of simplified approach
Yes, yes,
and
I was coming on to the
non
same only.
and non-disclosure of provision metrics
Mm,
pertaining to the same, I would
mm,
again open up this discussion. This is a
mm,
this is a categoric advisory issued by NAFRA. There are
mm,
debarments happening on this particular issue. That how do
mm,
you present? How do you calculate your expected credit loss? How do you present your provision metrics?
mm.
Kuldeep ji, if you can throw us some light, then I'll show an annexure based on this
Sure, sure,
also.
sure. So the issue which Ankit ji was trying to, highlight in this, my friends, is that it is related to this simplified approach only. So when you see the initial recognitions concept, or you read 109, you will come to know that all financial assets, barring trade receivables, are to be, initially recognized at fair value. For trade receivables, it is to be done at transaction price. This was NAFRA's advisory number one, if I'm not wrong. It came in way back in last
Correct,
March,
correct, correct,
2023. This mistake we have,
correct,
and I think we personally have seen, Ankit in I think more than 50, 60 odd listed companies, that the wrong accounting policy was disclosed. Now
Kuldeep
come.
ji,
Hmm,
I am I am slightly intervening. If audience did not understood the question, I am just reading what the policy is written.
hmm, hmm.
This is an incorrect policy
Yes.
contravening to the NFRA's advisory. The policy says the company follows simplified approach for recognition of impairment loss allowance on trade receivables, which is fine. I am agreed to this line. Now read Kuldeep ji, the application of simplified approach does not require the company to track changes in credit risk. Rather,
And
it recognizes impairment loss allowance based on lifetime ECLs in each reporting date, right from its initial recognition. Straight question. Does simplified approach exempts you to track the credit risk changes? If you're
or
doing
not.
that, then don't put up the credit risk exposure of your trade receivables down when you are writing
Yes, yes.
doing a compliance of Ind AS 107. So
So are
now
we
I have
posing this
opened this up.
question for? Are we
No,
posing
I
this
think
questions for?
I am
Okay.
I am saying I am not posing this because we are running short of time itself. But I am saying that this is the confusion which you have to clarify to all of us, that does simplified approach exempts us to track changes of the credit risk?
The answer is a simple no, Ankit, that while using simplified approach, it is nowhere written that it exempts you from, tracking the changes in credit risk. When you read IFRS, also or the Ind AS transition groups, bulletins, etc., and the Ind AS material, or the material which the institute has also published for, understanding how Indian accounting standards were carved out from the international financial reporting standards, you will come to know that it nowhere says that it allows you not to track changes. And when you will read these two lines again, they are contradictory in themselves. In first line, if
Absolutely.
I'm writing that simplified approach does not require me to track changes in credit risk, then what is the point in recognizing or what is the point of assessing impairment loss at each reporting date? It in itself means that you are assessing the credit risk at the end of each reporting period. So instead of writing this, I think the company should have written that the company uses the simplified approach, and it tracks the changes in credit risk at the end of each reporting date. So nowhere it is
and
written in the
and
India's.
and 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 recognizes impairment allowance based on lifetime ECL.
Yes, exactly. And you will find out in many companies why this accounting policy saga is more important. That merely writing an accounting policy in compliance with any Indian accounting standards or any regulatory order or circular will not suffice your purpose. I have seen many cases in which it was written correctly here, and that the application of simplified approach, we are tracking the changes at the end of each reporting date and recognizing lifetime impairment loss. But when you see the disclosure per 107 that you mentioned before a minute or so, you will see that the company is writing something else. That at the end of every quarter or at the end of every 6 months, we are tracking the changes in risk which is associated with the trade receivables, and based on the same, we are preparing the provision metric. So we need to be very careful while producing these policy or disclosing these policies as well as the notes to accounts, that there is no contradictory statements or disclosures given at two places. Like in accounting policy, I'm saying something else, which may be correct as per Indian accounting standard, but when it comes to notes to accounts, I am saying something else. So I would suggest it is up to you. One more thing, which is involuntary kind of thing, that as many of the companies has already started doing, you can start disclosing these accounting policy along with the notes to accounts also. So it is better for the understanding of users of financial statement. Otherwise, if you ask me as an investor, I will go to page number 243, then I will read a policy, then I will go to page number like 400 and see what disclosure you have made in financial instrument. So it is advisable, and it is a very good practice per se to communicate your message to investors in a precise and concise way, that you present your
Transparent way.
accounting policy along with transparent
It
way,
brings
along with
more
the notes to account.
transparency. It brings more transparency.
Transparency.
So interestingly, last point, which
Hmm.
is about the disclosure of provision metrics, and
Hmm.
NAFRA found a lot of irregularities in disclosing provision metrics. In fact, NAFRA itself gave
Hmm.
us a format which was a
Hmm.
reproduction to IFRS 9, that how do you
Hmm.
disclose the loss allowance? And
Hmm.
companies still failed to inculcate these practices. Kuldeep
Hmm.
ji, I think you were very spot on in saying So why, how does regulator comes into picture in all these things? When he sees that there is a disparity between what policy you have written and what note you have given,
Yes, yes, correct.
right? So the policy for derecognition of a financial asset and financial liability on which maximum SEBI adjudication has been done is what, you know, all the auditors, all the corporate reporting teams, all the investor community. I think that's one way to find out how transparent an annual report is, when you see disparity in what significant policies they have been giving and what notes have been coming up. In respect of financial liabilities, also again subsequent measurement, you have options, right? How financial liabilities needs to be recognized. The de-recognition of financial liabilities, nothing but a reproduction of index, will not be required. The reclassification of financial assets and financial liabilities to that extent shall also not be, you know, recognized. However, now see, Kuldeepji, here is a point of reclassification where, and that is why this policy becomes extremely important, because there's a reclassification which they have done while they were originally reclassifying things at amortized cost. The revised this fair value through profit and loss account, right? And how do you treat with their accounting treatments, right? The last is offsetting. Yes, please, Rangul Ji.
One more thing, I have not seen this sort of table in any of the other companies like accounting policy. Is it like according to it, it is it is something which will fall under the obscuring information part, or it is material to be disclosed?
Kuldeep ji, I have to go to their notes and see whether they have done this
Okay,
reclassification or not. So
okay.
I am not opening this up, but
Hmm.
there is another problem, that how do you initially designate a financial asset and financial liability? Because
Hmm.
people the companies are
Hmm.
not even showing that annexure correctly.
Yes, yes,
How
correct. Got
many
your point.
companies, I am posing this question with an expectation of an answer which you keep it to yourself. How many of you are categorizing your financial instrument based on the mandate of Ind AS 109, which
Hmm.
says that you have to classify what is initially, classify a financial instrument based on whether it is mandated by an initial instrument or whether you are taking it through fair value through profit and loss account, right? So we will discuss an excellent practice there itself. But
Hmm.
as of now, if there is no revised classification, this
Hmm.
is an obscuring disclosure. So,
Correct.
so I have not seen it. I am repeating it. Tomorrow I should not get a question on it,
Hmm.
that
Hmm.
why, because I have not seen the notes to it. But
Hmm.
naturally, the offsetting of financial instrument policy is something which will not be required to be disclosed as per the latest materiality matrix. This note has to come out very specific. In fact, each policy, we are in paucity of time and we want to deliberate whatever we can do it today. Kuldeep ji, we'll do it
Hmm.
today, else we line up another
Yes,
session.
yes, sure.
But
Hmm.
I wanted to go into detail of whatever we are discussing to the extent
Hmm.
we can
Hmm.
cover up, right?
Hmm.
So
Correct.
now I open up the reclassification of financial liability,
Hmm.
SEBI's adjudication order, which
Hmm.
can help the learned audience to understand the kind of gravity we are talking here about and
Hmm.
how regulator has responded to it. Kuldeep ji, which company you were talking about?
So it was like for de-recognition, to be precise, it was in Omkar Specialty Chemicals, and Omkar Specialty Chemicals will be like something which we should open. It is there in Royal Orchid also, but Omkar has a few more issues which we can discuss.
Okay,
Hmm.
so uh, Omkar, I am opening up, right?
Hmm. So one more thing, as a disclaimer, one should not think that these sort of adjudication orders or investigations can come or are going on for smaller companies. There are bigger and larger companies on which these sort of investigations or adjudications or assessments are going on. So it is applicable for one and same. It is for all companies. The SEBI treats everyone in the same manner.
Kuldeep ji, also the presentation which we have compiled talks about the top 100 companies itself, right?
Correct,
So
correct.
naturally, we did a conscious call of not correlating the presentation with the order, right? Uh, this is a conscious call, but a similar order with regard to that non-compliance could be very well found. Kuldeep ji, if you can quickly tell the background of the case, the stand of Ministry of Corporate Affairs, and the stand of Institute into the same.
So basically, what happened in this case, there was, non-compliance of Ind AS 23, 34, and 109, three type of non-disclosures. And in 32 per se, when you read 109, you will, 32 will like Vikram Betal ki tarah, it will be there everywhere. So there were three issues. One was related to, recognition of interest expense per se. It was related to capitalization. I think I would request Ankit ji, you to deliberate little bit on that borrowing cost capitalization, non-compliance that we have seen in many companies. The
Sure,
second
sure,
issue
sure.
was pertaining to like de-recognition of a financial liability. So the company had some some good amount of interest expense which was unpaid or which was not paid, and the company has reversed it or de-recognized it because since it was in financial liability, when you read 32 or 109, it says that it cannot be de-recognized. It can be extinguished or de-recognized or only when the obligation to repay the same is fulfilled or is discharged, or as per the contract it is not payable per se. So merely in this case, the company was assessing the situation, and they were not in a situation to pay the debts, so that they thought, and they replied in this letter also, that since we are not in a situation to repay, we will de-recognize a financial liability. So then SEBI went very interestingly, Ankit, I have not seen many cases, but in this case, SEBI sought an opinion from the expert opinion committee of ICI, and this is the committee's opinion which we are showing on the screen. Then the SEBI went to MCA also. MCA also said the same, that boss, it is not the way you can de-recognize or take out any financial liability of
In
your
fact,
out
MCA
of
sought a clarification from Institute itself, the
yes,
expert
yes.
advisory
Hmm.
committee in this
Hmm.
case.
Hmm. Correct, 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 correct. So, in totality, when you see this, it is very clear that when it comes to presentation and disclosure, when it comes to initial recognition, like Ankit ji has mentioned, that most of the companies fail to desegregate that what all financial assets and liabilities were mandatorily recognized at say fair value or through PNL or through OCI upon initial recognition, or what is done at a subsequent at the time of subsequent recognition. So basically, the issue here was related to de-recognition of financial liability, the interest expenses which were unpaid. Company thought that yes, we are not going to pay, or we are not in a situation to pay. Let's reverse it. So very interestingly, two more observations out of this. Then you can I'll hand it over to you, Ankit. When you see, as you were discussing about one company's case in which the chairman said that it is not my responsibility, I've made a system, and the system is responsible for the same which is headed by the compliance officer or CFO. In this case, when the clarification was sought from the chairman and the full-time directors, they said that they don't have any knowledge of Ind AS. So it is
Kuldeep ji,
not.
I have put this up for you. I hope this
Hmm,
is what you're talking about, right?
hmm. Yes, yes. So they said that they said, no, no, I'll come to this. You need not to don't change that particular slide. So then the CMD and the director said that it is not in our knowledge. We don't have any knowledge of Ind AS, and hence we can't be held responsible. So those whosoever are sitting at the key important, positions of listed entities, or from auditor's perspective also, it is very, very important from our side, or to see whether a disclosure is going in a right way or not. Then comes the screenshot or the snapshot that you was showing, Ankit. If you remember in the beginning, I spoke about appointing a financial reporting reviewer, or discussing the responsibility of directors or the management about the quality, or the true and fairness of the financial statement. So for 30 seconds, if you can open that particular snapshot, then I'll hand it over to you.
Sure. Give me
So whenever friends, you see that everywhere it is written in the audit reports that preparation of financial statements are responsibility of management, but you need to follow the same in letter and spirit also. So when you talk about any specific SEBI regulation which mandates the same, then you should read regulation 4.2 Roman 2 and subclause F. It clearly says that it is the responsibility of the management to prepare in quality of disclosure also. So in my opinion, this is something, this can be termed as a weird view also, that either either like compliance officer or CFOs, you create a post in between your company, or you take help of any external consultant which is independent, external company, or any audit firm which is independent of your statutory auditors, to maintain the independence thing, which is very under focus by NAFRA as well as SEBI. So when you read the beginning, can you read? Hold on for a second. In this regard, it is noted from Regulation 42F27 of LODR that one of the key functions of the board of directors is to ensure integrity of the listed entities accounting and financial reporting system. So this and the appropriate system of control, which is being taken care of by the IFC check or the internal auditors, etc. But this integrity of listed entities accounting and financial reporting system in itself is different from preparation of financial statement. I would like Ankit to add few things in this, and then we can move forward.
Kuldeep ji, I think it's self-explanatory. If I have
Okay.
to add something, I will add on non-financial part,
Sure. We
right?
can move.
Because if
Hmm.
we can add it right away, because we are talking about the responsibility statement itself, right?
Hmm.
And uh, lot of companies, as you know, we began with the session, we were talking about the integrated reporting structures, right?
Hmm. Hmm.
Kuldeep ji, I want to show you something which we have put up in this
Sure.
slide also,
Hmm.
and then we move on the financial side, right? Kuldeep ji, when you prepare an integrated report, right,
Hmm.
you are expected to give a statement.
Hmm.
So this the same penalty
Hmm.
or the same adjudication of regulator.
Hmm.
In that case, the
Hmm.
regulator was possibly a stock exchange,
Yes.
right?
Hmm.
A same penalty given
Hmm.
because of these kind of statements.
Hmm.
I am saying we have slightly shifted from financial to non-financial. Only
Hmm.
one aspect I am covering here.
Hmm.
Please, learned audience, CFOs, CEOs,
Hmm. Hmm.
please read the accountability statement which you are publishing as per
Correct.
IIRC framework.
Hmm.
And the statement which are furnished is
Hmm.
to ensure the integrity of the facts and information. The
Hmm.
board of directors and management of the company has reviewed the integrated annual report. The
Hmm.
board of directors confirms that the integrated annual report taken as a whole is
Hmm.
fair, balanced, and provides necessary information to stakeholders of the company's performance, business
Hmm.
model, and strategy, together with a description of material risk and opportunities. My
Hmm.
concern here is, Kuldeep ji, all
Hmm.
these companies are getting their annual report preparing through some marketing companies,
Hmm.
preparing through some corporate communication consultants. who don't understand the gravity of the statement which is being furnished on the
Correct.
face of the annual report. How will SEBI exempt you
Correct.
for each of the matter which you are stating in your annual report? Right, you have already undertaken a responsibility. And the problem I'll highlight, then we will come again on the financial part, Kuldeep ji. The problem is in India. Not even if we expect as of now 250 to 300 companies preparing an integrated annual report, correct? Or maybe more
Correct.
than that.
More
Not
than that,
even I
I would say.
have not found, or we together have not found 3-4 companies complying to the framework which SEBI has prescribed, complying to the framework which NSE has prescribed, complying to the framework which IRC has prescribed. So the concern is all these, now this annual report, initially we only had corporate governance section and financial statement section, which was driven by statute. Then we had management discussion and analysis section, which was also driven by LODR. And
Correct.
in fact, in management discussion and analysis, I don't know what has happened to these companies. They have started compromising their MDA sections in light of preparation of an integrated report. Either they're cross-referencing, that these are those aspects which we have to discuss it. But most importantly, the integrated reporting framework comes from a mandate of law. The BRSR framework comes from the mandate of laws, and they need to be prepared in accordance with the laws, because both these reports are certified with a statement which is given by those who are charged with governance. And now when we started seeing the penalties of a regulator coming on the non-financial sections of the annual report, that's what creates creates the trouble. So over to Kuldeep ji, let's go
So
back.
just to add one thing, and just to pose a question for the audience also, for the audience from you, that when you talk about and writing an accountability statement, so according to how does it flows, or ideally how should it happen? Like merely writing in the report will suffice, or there is something like a letter from the board of directors, or from your like the committee which is responsible, say audit committee or CFOs or KMPs. What should be the ideal way? I just wanted to know what should be the ideal way it should
So
be done.
Kuldeep ji, I
Hmm.
think you have posed a very interesting question. To
Hmm.
all
Hmm.
those who are giving this statement in their integrated
Hmm.
annual report,
Hmm.
none of the companies I find, when
Hmm.
we look into the statutory part of it,
Hmm.
has given us a documentation which is being furnished by board
Hmm.
with
Hmm.
respect to this. A board has to furnish a certificate, which then the compilation of, or the language of the certificate needs to
Hmm.
be imbibed in the annual report of the company.
Hmm.
Second, how does this come?
Hmm.
This
Correct.
comes when you write the governance structure
Hmm.
of your company with respect to integrated annual report.
Hmm.
Not anything else. I am not talking, Kuldeep ji, I reiterate, I am not talking in respect of corporate governance. There we give our
Hmm.
governance structure.
Hmm. Yes. 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 Yes.
Or when you prepare a BRSR report, you would realize that we give the G stands for the governance,
Yes.
and
Yes.
we give a
Correct.
governance structure there. For an
Hmm.
integrated report, there has to be, maybe your sustainability committee is itself responsible, or any other committee
Hmm.
which has been authorized by the board has been
Hmm.
responsible. This committee has to propose to the board that how the integrated methodology was followed in the entire year, and that's
Hmm.
where a board is expected to give a certificate.
Hmm.
And then only this statement can come. This is not a marketing document or a marketing channel, or a way of collecting money from investors, that you furnish anything on the face of the annual report.
Hmm. So I think
So that's
you have you have just to add one thing, that you are saying something which is very significant. I think myself have also not thought from that perspective, that whatever I am writing, yes, but if you see that an annual report is in a statutory document, it comes out of requirement of regulation 34, and whatever you are writing in the annual report has to be, justified or correlated, has to be, supported within proper document or proper authorization, etc. So this is something which is very, 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 significant from the perspective of non-financial
Exactly.
accounting also. Yes, very, very
Exactly.
important.
So
Hmm.
that's where I think, and that's where you see SEBI now coming into picture. So as of
Hmm.
now, they
Hmm.
were only charging for the financial accounting, financial policies. A
Hmm.
CFO is as much as responsible for an integrated report as much as a secretarial or an investor relationship team is.
Hmm. Hmm.
Otherwise,
Correct.
how do you put up your financial capital, which you are getting an assurance on?
Hmm.
So let's move ahead to this. I think enough of
Hmm.
uh, the gray areas. Let's talk about the finance side again and the financial
Hmm.
disclosure again. Kuldeep ji,
Hmm.
what is the problem with this annexure? This is as per,
Hmm.
to me, it appears as per, the requirements of the Schedule 3.
नहीं, see, if it is as per the requirement of Schedule 3, if you see it from bare eyes, but if you want to comply with the law, as I said in the beginning, that in letter and spirit, and what if you want to understand what statute says, then it is not in compliance with what Schedule 3 says. And the problem starts with this reason for not being held in the name of company. So this company has disclosed the reason as pending litigation. But my friends, when you read the Schedule 3 as well as the guidance note issued by our own Institute of Chartered Accountants of India, you will see and you will figure out that it is clearly written that if any title deed is not in the name of company, then in that case, if it is due to litigation, then the stage of litigation or what can be the probable outcome, say at what stage it is there and what is happening, it should be disclosed. And otherwise, then the actual reason has to be disclosed. Merely writing that pending litigation, or it is in process of getting transferred or getting registered in the company's name, and it is there since last like 24, 30, 50 years, 40 years, it will not serve the purpose. It is an grave and sheer non-compliance of Schedule 3. And Ankit ji, if you remember that when we were discussing in morning, I shared that one order which was related to, I think, disclosure of if any fixed assets are being placed, and the company was not giving the
Let me
qualitative
let me
disclosure. Hmm.
let me quickly check. Give me a
Hmm.
minute. I'll
Hmm.
check this. Yes, I recall this discussion. So, Kuldeep ji, are you saying that such kind of disclosures are not only the problem of I would say not transparency. This is
Hmm.
like a translucent disclosure. कुछ
Yes,
दिख
yes.
रहा है और कुछ नहीं दिख रहा है.
कुछ नहीं दिख रहा है. Correct, correct,
But
correct,
but
correct.
the intent of the law is completely defeated.
Yes,
The
completely
intent of the
defeated.
law was to give the stakeholder a clear view as to why
Hmm.
we are not able to get these title deeds registered
Hmm. Correct. Hmm. Correct.
and the status of the litigations.
Yes. And that was the,
So,
I think, logic behind coming up with this particular amendment. Else, merely writing that it is under process of being transferred or whatever it will not serve the purpose in any case.
right. So, so Kuldeep ji, I'm just figuring out which company did you talked about,
Hmm.
pertaining
Give,
to the same.
give me a
It
second. I am
was
also looking. Hmm.
right because it's been since morning that we have been looking at what do we
Hmm.
present it to you,
Hmm.
and I'll tell you the name of the companies again. I
Hmm.
think it was CG Power,
CG Power, the issue was related to offsetting of financial assets and liabilities.
Bombay Dyeing.
Hmm. Can be in Bombay Dyeing.
No, it is a consolidation issue.
The issue was pertaining to Index 16 classification. Give me a second. I'm looking at my notes. Can link to. Maybe in Magnum Ventures. Can you check once, please?
India's 23, India's
No,
109.
in Index 16. It will be in Magnum Ventures or Agritech, if I'm not wrong. Any of these two.
It is in Agritech. Got it.
Hmm.
Okay. So I share this, the exact issue, what Kuldeep wants to deliberate.
But I would request you to deliberate a little bit for all of us on this Index 16 property, plant and equipment, and some sort of other common non-compliances, because I think
Sure.
I know that you have a very good hold on this particular type of disclosure, and it is one of your favorite areas also. So please share
I,
your
I,
views, and
I,
then
I'll
we'll.
try.
Hmm,
I'll try to justify this.
hmm,
Let's first look at the order, or
Yes, yes,
do
sure.
I need to, uh, and
Me
then
first,
I'll
I'll.
come on
Hmm,
Index
Sure, sure.
16.
So, friends,
Right.
this is not exactly related to what we were discussing. Like we were discussing about title deeds not held in the name of company, but it is one and same. Very often we see that below the note of property, plant, and equipment, it is written that the XYZ amount or assets are being pledged for the purpose of getting a loan or a cash credit limit or some other purposes. So from where the disclosure requirement come, the disclosure requirement, come from para 74 of Index 16. So it talks about the way and what amount of information is required to be disclosed. So it is not merely writing that a particular asset is being placed, or out of a particular class of asset, a certain amount is being placed for getting a loan, but you need to give qualitative disclosures also related to the kind of restrictions or the kind of conditions which are being placed by the lessor or the lender in relation to the transfer of titles or the uses of the property, plant and equipment. So basically the issue in this particular case was related to non-disclosure of information. Still the case being that the company had already placed a certain assets, immovable properties for getting a loan, but the disclosure related to pledge or the qualitative disclosure was not coming out. And I think, if I'm not wrong, Ankitji, then the SEBI has come out heavily on the compliance officer and the CFO also in this case. So basically, this was an brief of what happened in this particular case, and I would like Ankitji to add to what other non-compliances which we see in Index 16, because I think you can cover a little bit of that borrowing cost thing also, which relates to 23, but which is related to 16 also. So this is related to yes, it is 116. Almost all indices will be covered. So are you there, Ankitji?
Sorry,
I
I
think
was
you
on
are.
mute. I almost deliberated the entire Index before mute. And also,
Uh,
my photograph is not visible. That's another issue.
yes, yes.
But I'll come back. I'll come back. So I am saying
Hmm,
we have covered all Indias in one annexure. That's problem number one.
hmm,
When, because there are different requirements to each India.
correct.
So when you
Hmm,
talk when you talk about an intangible, that is 38. When you talk about a lease, which is
hmm,
116,
hmm,
I think all this needs to be one. It has to be bifurcated properly, because whatever footnotes I have to give below my property, plant, and equipment, right?
hmm,
I will be
hmm,
able to give it in a concise way. Otherwise,
correct.
imagine the footnote following this entire annexure is half of the annual report itself.
Yes, yes.
So now, 2-3 important things, Kuldeepji, when you talk about common mistakes. Mistake number one, I found an order of SEBI pertaining to identification of a fixed asset.
Is it so?
Right? Yes. So which talks about, so I'll go back to the material accounting policy here. When you put up a policy of PP and depreciation, right? You categorize your assets, correct? So you categorize your assets based on the years of life.
Correct.
And parallelly, you check this life correspondingly with the Schedule 2 life prescribed by Companies Act 2013.
Correct.
Problem number one, if there's a deviation, companies are not disclosing the reasons for this. They're using a subjective language that management estimates. Right. So management estimates se kaam nahi chalega. It has to be the clear reason as to why a useful life has been considered more or less if it is in respect to Companies Act. The second, which was pertaining to the SEBI order, was that this company, certain companies do very broad classification of their fixed assets. Right. When you look at the Schedule 2, when you look at the even you look at India 16, even you look at the Schedule 3 Division 2, the classification of property, plant and equipment, you have to classify into the major class of assets that can be held together, which are of similar nature of use.
So will you share?
And
would you like to share
also
that?
this gives
Ankit ji,
a
one
more
thing.
crisper disclosure.
Would you like to share that order also, or without sharing the same? We continue with that.
I'll do my deliberation and then maybe we can,
Yeah, sure.
because we are already
Sure,
at
sure.
4:42. I don't know how
Sure,
much
sure.
we'll be able to take this from here, but I told you whatever we wanted to deliberate, we wanted to deliberate at length. So Kuldeep ji, your point number one, whatever property, plant and equipment is pledged in compliance to borrowing cost, right? You have pledged for your loans, correct?
Yes, yes,
Now
for
your
obtaining
borrowing
loans.
cost, which is capitalized, and the property, plant and equipment which is pledged, this needs to be disclosed as a part of the footnote. Now, will you
Correct.
disclose it after the right of use of asset? It had to come after PP,
Yes,
and
yes.
lot of
Correct.
companies are not disclosing the borrowing cost which are capitalized as per Ind AS 23 below the footnote of property, plant and equipment. And not only because the reason to disclose it there is because you have to identify the property, plant and equipment which has been pledged. Point number one. Point number two, with respect to goodwill. Now look at this annexure. Ind AS 16 categorically mandates you to classify depreciation, accumulated depreciation, and accumulated impairment
Yes, yes. Correct.
separately.
Yes, yes, separately.
Your accumulated depreciation, accumulated impairment has to come separately.
Agreed. It should come in that way only. I think we lost your voice in between. We lost your voice in between.
How do you classify it? Which is, do I come now?
Yes,
Are you
yes.
able to hear me?
Yes. Now we are able to hear. You were saying
Okay.
that the impairment has to be shown separately, accumulated impairment. This is a requirement of.
Exactly.
Yes.
Right. Right. This is critical, and you will
Critical.
not to what is depreciation and amortization? What is expected to be the depreciation accumulated amortization to arrive at, net book values.
Ankit sir, could you
Kuldeep ji,
please
what
repeat
is
this part? Ankit ji,
the
could you
carrying
please repeat this part? Your
out of
voice
my
is
voice is
not
reaching or
audible.
not?
It
Now
is
it
now.
is audible.
Yes, now it is audible.
Uh, right. I'll try to stop hearing me out. Just interrupt me. Uh, so I am saying, Kuldeep ji, the idea was not to arrive at net book value, right? Instead, we had to arrive at the carrying values of each property, plant, and equipment.
Hmm.
What kind of terminology? This is a FMCG conglomerate, one of the top FMCG conglomerates of the company. I'm highlighting it here.
Hmm.
And then when you look PG property
I think we lost your voice again.
Yes, Ankit sir.
Hmm. So what I would complete this for you. I think इसमें ही कुछ अटक रहा है. So what Ankit ji was trying to say that when you see this disclosure of property, plant, and equipment, the snapshot pertains to a very large FMCG conglomerate. So they've merged each and everything all together. The fixed assets are there, the intangibles are there, and other right of use assets are there. But these all different class of assets are being governed by different Indian accounting standard. They have different sort of disclosure requirement also. So he was talking about the disclosure requirement pertaining to showing the depreciation and accumulated impairment separately, as well as he was talking that when we talk about showing borrowing cost which is being capitalized during the period, so it is to be shown along with the note of property, plant, and equipment. It can't be shown under after the note of right of use of assets. So it is the way of disclosure. So there are too many separate disclosure requirements which were being mixed by this particular entity in this disclosure. And KG, if you are back again, then you can share the screen and continue. If are you there, Ankit ji? So I think there is some technical lag, Samandeep ji, in Ankit ji's internet connection. So
am I audible?
yes, the audible now,
Yes.
Yeah, then I don't think to hear.
audible now. Please come again. I think there is some technical issue.
Yes.
Technical issue. So till the time Ankit is back, like we are almost standing at 4:50. So I would like to just add one thing. I think we can take questions pursuant to that. Ankit ji, if you remember, we were discussing about the way, and I would like your inputs also, Samandeep, on this. Then that if you read or if you see any company's financial statement during the year, apart from annual report, what is something which is more important? So the companies present quarterly results as per the LODR mandate. We often see that it is a stereotype of same sort of disclosure in the publishing format which SEBI has given. But you will appreciate the facts. There are many companies which are coming out in a extensive way or in a detailed way. They are giving the management commentary, they are giving the CFOs or the chairman's message along with the same. They are giving other than in the con call, in the investor presentation itself, Pankaj, they are writing the target for the next quarter, what all significant achievements the company has been able to do in the past quarter, as well as what is the headwinds and tailwinds. So this is something which is a new sort of disclosure practice which companies have started adopting. And I would request you, Samandeep and Ankit, to have your views on this. That as an investor, do you see this as a important tool to communicate with the stakeholder in a better way? And then Ankit ji is back, so he'll finish deliberating on this particular slide, and we can take questions.
So absolutely, I think Kuldeep ji, if you are able to hear me out,
Yes, we are able to hear
Yes,
you.
yes, you're audible.
finally, I'm very sorry. I'm at a very
No,
very
it's
remote
fine.
location, right? So only thing is that uh, with regard to investor presentations, Kuldeep ji, I completely buy your point. When you talk about
Mm,
transparency, it is not only annual report is a one-time communication
mm,
document in the year. Quarterly, how
mm,
do you present your investor presentations? How do you present your
mm,
management commentaries? How do you
mm,
show your compliance to the regulator, the compliance to the standards, right? All these
mm.
things, merely just furnishing the financial results doesn't solve the purpose itself, right?
Correct, correct.
If you're really looking at transparency. So I
Mm,
am with you on that. Lastly, I'll
mm,
just conclude this annexure, and maybe
mm,
Samandeep, for non-financial, we can have another session lined up, right?
mm,
Because the non-financial part is completely we have, even to that extent, I think the financial part is also left, right?
mm, mm.
Uh, Only thing my point here is, with this annexure, let's conclude this.
Mm.
Kuldeep ji, if you recall the investment property, hear me?
Yes, I recall the same.
So now in an investment property index,
Mm,
if there is investment property which you have to also disclose the fact, the quantum of rent you have received from this investment
mm,
property, the
mm,
quantum of expense you have done
mm,
for a particular investment property in two which was kept. So all these things also have to form part of this entire annexure. How do you make them? When you talk
mm.
about goodwill, then how do you bifurcate it into finite and infinite life asset?
Correct. Mm,
How uh, I am I am surprised to see such kind of practices, and regulators are constantly picking this up. So,
mm,
uh, so before we conclude this, I think this has a lot to deliberate on. We can maybe pick up another day and
mm,
take this forward. This is an initiative, Samandeep, which we, on behalf of Institute, we have to constantly, keep on deliberating how regulator is responding to it. I can show you notices and penalties, and hefty penalties, a penalty quantifying to an extent of 1 crore on the KMPs and 20 lakhs on CFOs on such kind of substandard disclosures. So we
mm,
have to be very, very conscious while we write our reports, very conscious while we write our financial disclosure, extremely conscious when we benchmark a framework for a non-financial reporting, be it integrated reporting or be it BRSR reporting. And that's
mm.
how the transparency starts coming up. I and Kuldeep ji are opening up for question, and then we put our closing remarks, Samandeep.
Right, sir. I'll get on to the questions part. So the more of a follow-up question is, could you please share the complete MCA notification number with the date, the one that you displayed earlier?
Uh,
Related
it
to
is a public document, but Samandeep, we will share it with you, and you can share it with the participant.
Definitely, I'll do that. So there's another question. While signing the audit report, what aspects should be considered which are included in the annual report by the management?
So from auditor's perspective, right? So I think you will be only accountable uh,
financial
to
part.
the extent of the financial statements and any certifications, if you have been giving it as a part of your corporate governance, which is primarily secretarial job only, but primarily look into the financial statements, look how meticulously these policies are, material accounting policies are, look how meticulously the notes to accounts are
Ankit sir, if you could turn
designed
off your
and everything.
share screen. I believe it's consuming a lot of bandwidth and we're not able to, the participants are not able to hear you out. And if you could just please reiterate what you've just said.
I just said that, Kuldeep ji, please, better you deliberate, because my voice is
No, it's fine. So
not coming
what
well.
point Ankit was trying to make is that from auditor's perspective, I shall be held responsible or accountable only for the financial statement related part, which may include some sort of certification that I've done for the corporate governance section, which is primarily a secretarial job, but in some cases, chartered accountants are also giving these certificates. But from this year onwards, it is important and imperative for me to check how the accounting policies are being drafted and whether the disclosures and policies hand in hand presenting a true and fair view. So to sum it up, I would say that if like Ankit was speaking about integrated reporting's responsibility statement. So if there is anything wrong in that statement, or it is not, the integrated reporting is not as per IIRC framework, so in my opinion, auditors will not be held responsible for that, because we are primarily, our job is
Just one thing, Kuldeep ji, if I can pitch in between.
Sure.
I hope all chartered accountants, at least who are in practice and who are in service, are aware about a major change which happened in July 2020 pertaining to NOCLAR, which is non-compliance of other laws and regulations. So our code of ethics got revised, and chartered accountants who are KMPs in service are driven by NOCLAR, and chartered accountants who have practices are also driven by NOCLAR. So it doesn't exempt you. One, primarily you are not responsible, but secondarily, if you know a non-compliance has been done in respect to a corporate governance section or in respect to an integrated reporting section, then as a part of NOCLAR, you are expected to report same as per the revised code of ethics.
Correct.
And that's where the problem is.
Correct. Agreed.
Any other question?
Yeah, we have another 2 questions, sir. So it is requested if you could just deliberate a little more on role of quality review of the financial statements.
Ankit ji, it is your
yes,
favorite subject.
So generally, not generally, in fact, our institute has a very robust quality control mechanism, and we have 4 very critical boards monitoring the quality. The first board is Quality Review Board. In January 2019, this board moved to NFRA, and NFRA started doing the quality review audits. NFRA has their independent board, which is FRQRB, Financial Reporting and Quality Review Board. And whatever advisories we were discussing comes from FRQRB. Also, the trade receivables advisory, the provision matrix advisory. In fact, the quality review done by NFRA as of now is commendable. And I would say that, this imposes a lot of threat, and that's why you see a lot of debarments and everything happening. But the mechanism is clear that NFRA, be it a listed company, be it an unlisted company, be it a company in which public at large is not vested, can exercise their powers and review anybody's quality, any auditor's quality review can be done, and the entire firm is subject to the QRB. Whatever non-compliances are found, they are taken into deep consideration by NFRA. Almost all matters which NFRA highlights, NFRA also does an adjudication of it. Ideally, institute should have done it, being a quasi judicial body, but refers these cases to the institute's disciplinary directorate also. The second board is very important board. which is the Financial Reporting and Review Board. And this board was constituted in July 2002 in 226th Council meeting of the Institute. And there FRRB initially was not referring any cases to the disciplinary directorate, but later on a decision was taken where FRRB, in case if there are material misstatements in a financials, and FRRB will put this to disciplinary directorate. These are those companies in which public at large are vested, they are recognized at stock exchange. FRRB can go to that extent of discovering what Kuldeep was deliberating. Kuldeep ji, we were discussing Berger Paints annual report only, right? And we were seeing a statement written there, cash flow statement. So India has come up. I think we should now it's been 10 years almost. We should gear up. It is statement of cash flow, and this is not with Berger Paints. I can tell you the top companies writing cash flow statement. Such points are deliberated by FRRB. If a material misstatement is found, then these cases move to the disciplinary directorate. Earlier, Kuldeep ji, FRRB did not had the right constitutionally to question the companies. But however, now they have been given this power to communicate to the regulators. So you will see a lot of queries coming from FRRB side. The third is the peer review board, and the fourth is the tax audit and quality review board. We know the kind of mandate peer review board has taken. It is a strong mandate coming up. And friends, I think this is the last chance as professionals we can regulate ourselves, right? Unless we want more nafras, more external people coming and regulating it. Peer review is the best resort institute can adopt, and a lot of peer reviews have been done. Fourth is the tax audit and quality review board. If a CBDT has undertaken a audit, or you have done in compliance of income tax or CBIC or RBI or SEBI, and these audits are found to be of inadequate quality, then these regulators write to the tax audit and quality review board. These are the only four boards which ensure the quality review mechanism of the institute.
If I may just take a last question, sir.
Sure.
Yeah. Management have any discretion to remove if they have any accounting policy that is immaterial? So I believe the question in a better form would be: does management have any discretion to remove the content if they think that any accounting policy is immaterial?
Kuldeep ji, can I answer if you
Yeah, sure.
Sure.
No,
so it is not the discretion of management is expected to remove it. If it is an obscuring disclosure, you have to use this discretion, remove it, and make sure your accounting policy is in compliance to the standard and the amended notification which we discussed. So it is not auditor's discretion. In fact, it is management's discretion, and auditor has to see that there is no policy which is left out, which was a part of a material accounting policy change.
And that's where that materiality matrix, Samandeep, we discussed in the beginning, comes into play. When you talk about discretion, it becomes subjective. And when later on, after say 2, 3, 4 years, if somebody comes after you or any regulator or any investigation is going on, then if you don't have any such document with you, then you don't have any supporting or anything to say in your decision's favor that this is how I considered or I analyze any policy or any content of a policy to be immaterial or to be obscuring, and then I removed it. So it is up to you. You can remove the obscuring part. It is the mandate. You should remove the obscuring or immaterial part. But with that, you should have a proper materiality matrix or a document say supporting your decision, what you have done and how you have removed or how you have redrafted any policy.
Understood. Time indeed flies by when you're having good time. I really hope all our learned audience could make out the best from the rich experience of our learned speakers. At the beginning of the webinar, it was mentioned that trust is a very key and important factor. I can definitely understand now why it was said so. The transparencies from different regulators, exchange point of view, and our mother institute's point of view the difference between correct and incorrect and the consequences of the incorrect part. I surely have taken so much from both of your rich experience, and I can assure that our learned audience has also taken so much from your learned experience, Kuldeep sir and Ankit sir. On behalf of the entire committee, the chair and vice chair in absentia, I thank you from the bottom of my heart for taking out time from a busy schedule and deliberating on this very important topic. The committee would further like to and would love to rather come back to you for the non-financial part, as Ankit sir had said,
Sure.
and we can definitely schedule, subject to your both availability. We can definitely schedule a new webinar and make the most of your rich experience going forward. Thank you so much,
Thank you.
gentlemen. And I would also like
Thank
to
you.
thank
Thank
the
you.
audience to take out time on the day of this auspicious day of Mahashivratri and have Women's Day. I wish everybody who's listening to this webinar a very happy Mahashivratri and a very happy Women's Day. Thank you so much, everybody. That's a wrap from our end. Thank you. Bye bye.